We created the one for him for December 2005. Now, it can be seen that the three versions of B-Swift's trial balance have all been concerned with the same overall amount of goods bought and sold by the business. At the time, overall prices, therefore, in each case, the same gross profit of 12,500 has been found overall, right? Now, the second year of business now, at the end of the second year of trading, on December 2006, B-Swift draws up another trial balance. All right? See it here? Only this time, there is a stock at the end of December 2005 for 3,000. I think we went to this last class, right? So far, I've been looking at new businesses today only. When a business starts, it has no stock brought forward. Good. B-Swift started in business in 2005. Therefore, when we were preparing Swift's trading and profit and loss account for 2005, there was only closing stock to worry about, which, as you can see right here, closing stock alone. So there have been no opening stock, pretty much, right? However, I must tell you that the closing stock for 2005 will be the what? Opening stock for 2006. All right? So in this case now, so this is certainly your stock at December 2005. This should have been your what? Opening stock for 2006 in the TPNL, all right? All right, so when we prepare the trading and profit and loss account for the second year, we can see the difference. If you look back to the trading and profit and loss account, in exhibit 9.4, go up there. Come on. Sorry. Where am I? Brother. Let me in the books. Let me. Go through this. You look, I started at the wrong foot, Sorry about that, folks. I should have started with balance sheet this morning because I realized that I went through the simple TPNL account. What I was starting a while ago was a little bit more advanced one. So I think I did a practice one for your last class, which was this one, I believe, if I'm correct. I did this one as practice for your last class. So this one, sorry, we'll look at balance sheet this morning instead, all right? When we go further, we look at more detailed TPNL account. I fast forwarded to I moved away from, I was looking at this chapter about, let me see, make sure. This one I was looking at a while ago, which is not the one I should look at this time. See it? This one at all. This one is for later on, not for now. All right. You back to the balance sheet now and move from there. All right, now. So this morning we will look at balance sheets this morning. All right. Sorry about. So earlier you learned that balance sheets contain details of assets, liabilities, and capital, right? The items and amounts to be entered in the balance sheet are found in the accounting books. As shown in the previous chapter, they comprise those accounts with balances that are not included in the what? Trading and profit and loss account, as I told you before, last class. All these accounts that continue to have balances must be assets, capital, or liabilities. Join folks, please look out for some practice questions, which I upload the items for you. Practice questions that they are, so you can practice some accounts because you need to practice them, all right?
Yes, sir.
Let's continue. So, as you see in the previous last class, that the balance sheet comprises accounts with balances that are not included in the trading and profit and loss account. All these accounts that continue to have balances must be assets, capital, or liabilities. So, we would have eliminated certain of them last class, right? And use them in the trading profit and loss account. But there are some which we do not use. You realize that? We do not use assets, capital, nor liabilities any at all in last class. All right? Now, draw a balance sheet. Now, let's look at again at the post-trading profit and loss account in the trial balance for B Swift. It must be 7.3. All right, so B Swift, this is the trial balance as at December 2005 after they took out the items for trading and profit and loss account. So after the trading and profit and loss account have been completed, so we're saying after the trading and profit and loss account have been completed, the capital account adjusted for the net profit and drawings, right? So you see, go again. So this is the trial balance as at December 31, 2005 after the trading and profit and loss account has been completed and the capital account adjusted for the what? Net profit and drawings, which we did previously. All right, let me go up. Remember this? We adjusted for net profit, which is 8,000, drawings of 7,000, and the balance for the capital now is what? 21,000, right? So that's why you have a capital of 21,000 down here. All right. Right here. So therefore, this one is left off the trial balance after they have done the trading profit and loss account, right? So this is going to use. This is going to use now to make your balance sheet. Good. All right. You probably remember seeing examples of balance sheets before. If not, this would be a good time to spend a few minutes reading that chapter again, but no need to. But this would be the balance sheet. Right? So first thing you do, you would enter your what? Assets. Good. And you enter your fixed assets. So you'd have fixtures and fittings first, right? That will be 5,000. Then you will add in your current assets. And you start with stock, 3,000. Now the stock right here, the stock that you have right here is what we call your closing stock. All right. So the stock right here is your what? Closing stock, not your opening stock. Please note, the stock which goes into balance sheet is your what? Closing stock. Good? Not opening stock. So they have stock, debtors, bank, cash. All of these now are considered to be current assets. Good? Then you what? Less your liabilities, which is created in this case. Subtract 90,100 from 30,100, and that will give you $21,000. And then your capital, whatever. Remember now that the balance sheet equation, the accounting equation is what? Assets minus liabilities equal what? Capital. So therefore, any figure that you get right here, you should get down here as well. Good? Therefore, that is that for that. No double entry in the balance sheets. After the way we use the double entry system in the last chapter to prepare the information we needed in order to draw up the trading and profit account, it may seem very strange to you to learn that balance sheets are not part of the double entry system, which is right. When we draw accounts as a cash account, rent account, sales account, a trading account, or a profit and loss account, we are writing them up as part of the double entry system, where we make entries on the debit side and the what? Credit side of these accounts. Drawing up a balance sheet, we do not enter anything in the various accounts. We do not actually transfer the fixtures and fittings balance, or the creditors balance, or any of the other balances or the balance sheet to the balance sheet. All we do is to list the asset, capital, and liabilities balances so as to form a balance sheet. This means that none of these accounts have been closed off. Nothing is entered in the ledger accounts. When the next accounting period starts, these accounts are still open and they all contain balances. As a result of future transactions, entries are then made in these accounts that add to or deduct from these opening balances using what? Double entry. If you see the word account, you'll know that what you are looking at is part of the double entry system and will include debit and credit entries. The word account is not used. It is not a part of the double entry system. For instance, the following items are not accounts and are therefore not part of the double entry. Trial balance, this is simple list of the what? Debit and credit balances in the accounts. Balance sheet is not an account. This is a list of what? Balances arranged according to whether they are assets, capital, or liabilities, and so depict the financial situation on a specific date. The trading and profit and loss account is a special case. It's a financial statement and itself is not part of the double entry system. However, the trading account and the profit and loss account, which together provide information that is presented in the trading and profit and loss account, are individual accounts that most definitely lie within the double entry system. All right? But when they are put together, they are not a part of the double entry system, but when they are separated, they are a part of it. All right? We look at the balance sheet layout now. Now, the balance sheet you saw a while ago, right? Is a simple one. However, it can be more useful if it is improved, right? Firstly, we look at how assets could be presented in a more helpful and more meaningful way. So first things first, assets now. We are going to show the assets under two headings. You have fixed and you have what? Current assets, right? So fixed assets now are assets that were not bought primarily to be sold, but are to be used in the business and are expected to be what? For use to the business for a long time. Examples of fixed assets include buildings, machinery, motor vehicles, fixtures and fittings, etc. Fixed assets are listed first in the balance sheet, starting with those the business will keep the longest, down to those which will not be kept so long. For instance, you'd have land and buildings, then fixtures and fittings, then machinery, then motor vehicles. All right. So you start with what? Those the business will keep the longest, down to those which will not be kept so long. Then you have current assets. Current assets are assets that are likely to change in the short term and certainly within 12 months of the balance sheet date. They include items held for resale at a profit, amounts owed by debtors, and also cash in bank and cash in hand. So the items held for resale at a profit are called stocks. The amounts owed by debtors, they are called debtors, are accounts receivable. They have cash in bank and cash in hand. These are listed in increasing order of liquidity. That is, starting with the asset furthest away from being what? Turned into cash, finishing with cash itself. For instance, you have stock, then debtors, then cash at bank, then cash in hand. All right? Some students feel that debtors should appear before stock because it, at first sight, stock would appear to be more easily realizable, that is convertible into cash, than debtors. In fact, debtors could normally be more quickly turned into cash. You can often factor them by selling the rights to the amounts owed by debtors to a finance company for an agreed amount. All right? As our retailers would confirm, it is not so easy to quickly turn stock into cash. Another advantage of using this sequence is that it follows the order in which full realization of the assets in our business takes place. Before there is a sale, there must be a stock of goods which, when sold on credit, turns into debtors. And when payment is made by debtors, turns into what? Cash. Right? So those are the assets you have fixed and you have what? Current assets, right? And the fixed assets you start with what? Land and buildings first. And you go down. Currently you have stock debtors, cash in at bank and cash in hand. Right? There are two categories of liabilities now. You have current liabilities and you have also what? Long-term liabilities. Okay. Let me do the voice. Let me. Yeah, I was saying that so we looked at assets a while ago. Now we'll look at liabilities now, right? So we look at fixed and current assets a while ago. Fixed and current assets. So with fixed assets, we start with land and buildings. And you go down and then you have current assets, you start with stock, debtors and then cash at bank and cash in hand. All right? Liabilities now. So there are two categories of liabilities: current liabilities and long-term liabilities. Current liabilities are items that have to be paid within a year balance sheet date. Examples are bank overdrafts, amounts due to creditors for the purchase of goods for sale. Bank overdraft is like you basically owe the bank money because of an issue with your account. You have probably borrowed money from them on your account, to your account. And you have long-term liabilities now. Long-term liabilities are items that have to be paid more than a year after the balance sheet date. Examples of long-term liabilities include bank loans and loans from other businesses. Our population of balance sheet now looks like this. Exhibit 8.3 shows Exhibit 8.2 drawn up in a better style. Also read the notes following the exhibit. Now look at this now. So you have what? Fixed assets, fixtures and fittings. You have current assets, you have stock, debtors, bank, and what? Cash. All right. Then you have less current liabilities, which is created in this case, 9.1 from that give it. So your total current assets now is 21,000. Now this 16,000 right here is called working capital. But again, 16,000 right here is called what? Working capital. Right in it, put in a little thing there. This thing right here, just bring it over a little bit further. So the 16,000 right there, so we call it working capital. So this 16,000 right here, we call it what? Working capital. Good. All right, so when you're asked to do a balance sheet in the working capital, showing the working capital, this is how you do it. All right. And which is normally the case, which you're asked to do it in. All right. So that is working capital. So to calculate working capital is simply this: current assets minus what? Current liabilities. And that gives you working capital. Working capital equal current assets minus current liabilities. Put it in there. So this, please relog in as usual after the minutes are, relog in please as usual when the 2 minutes are up. So you have current assets minus current liabilities equal working capital. So current assets minus current liabilities equal what? Working capital. And in this case, your working capital is what? $16,000. All right. And your balance sheet is always balanced. If it's not balanced, means something is wrong. All right. All right, so that's it for that. We have this written down. Let's continue now. And then now you have a capital. You have cash introduced of 20,000. Please relog in before we continue. Relog in, please. So before we continue, relog in, please, before we continue. All right. Relog in so we can continue, please.